Alright, so let's now take a closer look at moving averages. Now, moving averages help me to tell whether the price is in an uptrend phase, a sideways phase, or a downtrend phase. And so again, let me just draw that. So again, there are three phases in any price pattern. We have got the uptrend phase, we have got the sideways phase or consolidation phase, also known as the range phase, and we have got the downtrend phase. And it's critical to know which phase you are in, because on the uptrend phase, you trade using different strategies. On the sideways phase, you trade using different strategies, and on a downtrend phase, again, you trade using different strategies. So you have to know which phase you're in. And the best way to tell is using moving averages. Now, everyone has their favorite moving averages. Some like to use simple moving average, some like to use exponential, some like to use the 18, the 20, the 50, the 6, and there's no right or wrong. It's what works for you, what works for your strategy. And over the years, I found that my favorite moving averages, which I use for Forex, especially the 50-minute candles, are basically 4 moving averages, as you can see from the charts. So the first is the 6 exponential moving average, the 6 EMA, which is this red line, thin red line. The 18 exponential moving average, which is the thin blue line. The 50 exponential moving average, which is the thicker blue line. So I've got the 6, the 18, and the 50. And finally, I've got the 200 simple moving average, which is the red line. Right? Now, for this advanced course, I'll be focusing mainly on the 18, the 50, and the 200. I will not be looking at the 6 moving average very much. That is used for the impulse pullback and impulse pin bar strategy. So how do I use these moving averages to determine the market phase or the price phase of the currency pair? Well, the first thing is I always look at the slope of the moving average. Okay? So the first thing is to be aware of the slope. The second thing to be aware of is the sequence of the moving averages. In what sequence are they in? So these are the 2 keys to it. Now, generally, when moving averages are sloping up, that is an uptrend. When moving averages are kind of like going sideways, then obviously we're in a consolidation or in a range. When moving averages are clearly sloping down, we are in a downtrend. So always look at the slope of the moving averages. Extremely important. The next thing I look at is the sequence of these moving averages. So generally, on a very strong uptrend, what do we see? We see the moving averages in sequence from the smallest to the largest. So we see the 18 above the 50 and the 50 above the 200. So this is a signal of a very strong uptrend pattern. Conversely, on a clear downtrend, we see the opposite sequence. We see the 200 moving average on top, followed by the 50, and followed by the 18 moving average. So let's take a closer look at the charts to understand this concept. So I'm looking at the Euro USD 50-minute candles, and you can see during this part of the chart, we are in a very, very clear uptrend. Why am I confident we are on an uptrend? During this phase or this section of the chart. Again, do you see that clear moving average sequence? All right, you can see this blue line is the 18, right? So the 18 is above the 50 and the 50 is above the 200. And they are generally in a sloping up fashion. So this is a very clear uptrend. So whenever we're in a clear uptrend, we always look to buy. Okay, we always want to follow the trend. The trend is your friend. Whenever you buy on the uptrend, the odds are in your favor. You're taking a high probability trade, and the probability is that prices tend to go up on an uptrend. So you always want to buy during this uptrend phase. Now the question is, when is the best time to buy on the uptrend phase? You want to buy during a temporary correction to a support level, a temporary correction. So what do I mean by that? So remember, on an uptrend, prices don't go up in a straight line. They go in a wave-like pattern. So first, it will move in an upward fashion. We call this the impulse wave. So the impulse wave is the wave in the direction of the trend. So the trend is up. So the wave going up is the impulse trend. And we then have a corrective wave. The corrective wave will end at some point of time before the next impulsive wave, and the next corrective wave, and next impulsive wave, and it continues. All right, the trend continues. So again, I like to use a metaphor of breathing. Okay, so this is breathing out, breathe in, breathe out, breathe in, and breathe out. Yeah. So on this uptrend pattern, again, when is the ideal time to enter? We want to buy ideally towards the end of the corrective wave. So it corrects, and just before it starts the new impulse, we want to be a buyer right there. Right at the end of the corrective wave before the next impulsive wave. Similarly, at the end of this corrective wave, we want to be a buyer over here. And to enter, to catch the new impulsive wave. And of course, to take profits somewhere here. To take profits somewhere here. Okay? So the question is always, how do you know it's the end of the corrective wave? How do you know that it has, retraced enough and is going to move up after moving down for a while? Well, that's where, again, moving averages come in. So moving averages on an uptrend, the moving averages act as a support level. All right, so you can see that at times, now again, it doesn't happen all the time, but when it happens, it is very reliable. Notice on a very clear uptrend, whenever the price goes through a corrective wave, it tends to find support at one of the moving averages. So can you see impulse, right? You can see impulse moving up and corrective wave. What happens? It finds support at the moving average. Can you see at the blue line? The blue line acts as a support, and then it goes up again, supports here, goes up, supports here, goes up, supports here, goes up, supports here, goes up, supports here, and then it continues, right? So once you identify an uptrend, we look to buy the moment the price hits the support level. It hits the moving average, which is, for me, ideally the 50 moving average. So hits the 50, buy, hits the 50, buy, hits the 50, buy, hits the 50, buy. And we keep repeating this pattern again and again until the uptrend ends and it starts to go into a consolidation or a downtrend. Okay? Now, again, always remember, we are only confident to buy when it hits the moving average. When it hits the 50 moving average, only on a very clear uptrend. And again, how do you know it's a clear uptrend? Like I said, look at the sequence. The 18 must be above the 50, EMA must be above the 200. And ideally, at that point, they should be generally in an upsloping fashion. All right, so moving on, let's take a look at this portion of the price trend. Okay, so you can see that, for example, in this situation, when you're looking at the chart and you see that the moving averages are not clearly sloping up and they're not clearly sloping down. They are kind of like moving sideways. Can you see that? Right? The blue is like moving sideways, going down, going up, going, right? And the red is like that, right? And so when the moving averages are kind of like moving sideways and they're crisscrossing each other, and the 50 is above the 200, then it goes below the 200, it goes up, what happens? So in this situation, you never want to buy when it bounces off the moving average, okay? Because it is not an uptrend. You only buy when it bounces off the moving average on a clear uptrend. This is known as a consolidation pattern. Consolidation pattern is when it moves sideways, okay? And in this structure, we use a different strategy known as trade the range, which again, you're gonna learn in lesson 4. So when you see it in this fashion, you only want to buy when it bounces off a strong support level, okay, that we draw using the lines. And we can also sell short when it's at a resistance level. But I'll teach you that you only buy at a support on an uptrend bias, and you sell at resistance on a downtrend bias. And again, I'll talk more about that later on, so again, hang on. So let me show you an example of a very clear downtrend, okay? Let's go to dollar franc, another currency pair. So you can see that, again, in this phase over here, it is neither a downtrend or an uptrend. It's in a sideways pattern. But over here, we are in a very, very nice downtrend phase. So again, how do I know it's on a downtrend phase? Two things we look at. Remember, number one is the slope of the moving averages. Number two is the sequence of the moving averages. So can you see that all the moving averages are clearly sloping down? Okay, they're all sloping down like so. And again, notice the sequence they are in. It is arranged from the biggest moving average to the smallest moving average, from the top to the bottom. So you've got the 200 simple moving average, the red line. You've got the 50 moving average, exponential, the blue line, and the 18 exponential moving average. So 250, 18 in sequence, clear downtrend. So on a downtrend, what do you want to do on a downtrend? Well, you always want to sell on a downtrend, because on a downtrend, the probability is that prices will always go lower. So you always want to trade with the trend, never go against the trend. The trend is your friend. If you all you do is sell on a downtrend, all right, chances are you're gonna make money, because prices tend to move on a downward fashion on a downtrend. So again, when is the ideal time to sell on a downtrend? Again, on a downtrend, notice that prices don't go down in a straight line. Okay, they go down again in a wave-like fashion. So what's a wave-like fashion? Again, you've got the impulsive wave. And the impulsive wave is, again, the wave in the direction of the trend. So the trend is going down, the impulsive wave is going down, and then you have got the corrective wave, right? The corrective wave. So you breathe out, breathe in, breathe out, impulsive wave again, breathe out, breathe in, and breathe out, impulsive wave. All right, so we have got this fashion that you see here. Okay, so breathe out, breathe in, breathe out, breathe in, breathe out. Breathe in, breathe out, breathe in, breathe out, breathe in, breathe out, breathe in, breathe out, breathe in, and it continues. Can you see that? Okay. So when do we buy? When do we sell? When do we do a short sell? When do we sell the currency pair? We sell it at the end of the corrective wave. So it goes down. When it goes up, the moment it's towards the end of the corrective wave, we want to sell at that point. Okay? And once we sell, when it comes down, we are making money, and we quickly take our profits somewhere here. We take our profits, TP. Okay? And then we wait for the next corrective wave. Again, once we see that it's towards the end, we do another sell, and we catch the next wave down. So again, how would you know where is the end of the corrective wave? How would you know? Again, we use moving averages to help us. Because on a downtrend, the moving average, especially the 50 exponential moving average, acts as a resistance level. So whenever the price hits the 50 moving average and finds resistance, I want to be a seller. Okay? So let me clear that out, clear it for you. Let's take a look, right? So you can see it's going down. goes up, hits the 50 moving average, comes down, hits the 50 moving average, resistance comes down, hits the 50, resistance comes down, and it continues. And again, you keep doing this as long as the downtrend prevails, right? Until it changes trend. So we want to sell right at that point. And this is called the bounce strategy. We're selling it as it bounces off the 50 moving average on its way to make a lower low on the downtrend. And again, you only do this on a very clear downtrend. So how do you know it's a clear downtrend again? Tell me. That's right. All moving averages are sloping down. We've got the downtrend sequence of the 200 on top. We've got the 50 here, and we've got the 18 over there. Alright, so we've talked about support and resistance. We've talked about moving averages. Now let me talk about the next very important technical concept, which is aligning multiple time frames. So remember that before I continue, at this point of time, I'm not talking about strategy yet. So if you're wondering, Adam, what's the exact entry point? What's the exact exit point? We'll come to that in lesson 2, 3, and 4. Those are when we dive into the exact specific strategies. As of now, we're just going through concepts to understand how technical signals work, and we're then going to put it together in the strategy section. So hold on to that and just understand the concepts at this point of time. So what do I mean by multiple time frames? One of the biggest mistakes that traders make is when they trade on a particular time frame, they only look at that time frame. Okay, so for example, if traders trade on the 50-minute candles, they say, okay, if the 50-minute candle says a downtrend, I'm going to go short. On an uptrend, I'm going to go long. Okay, now you can't do that because it is not reliable. If you're trading on the 15-minute candles, you must always check a higher time frame level, like the hourly candles, to ensure that the hourly candles are also on a downtrend, that are aligned to the 50-minute candles. Similarly, if the 50-minute candles show you an uptrend, you must also see an uptrend on the hourly candles. So you must always make sure that the higher time frame is aligned to the time frame which you're trading in. Now, if you happen to be trading on the 1 hour time frame, if that is your strategy, which is not mine, but it is yours, then you have to double check with the 4 hour time frame, H4. If you're trading on daily candles, then similarly you have to go up to the weekly candles to confirm your daily trend. Does it make sense? Yeah. So again, because we are looking primarily at 50-minute candles, I would always check the hourly candles to confirm alignment before taking a trade. So let me give you an example of what I mean, right? So let's imagine the price is moving up here, okay, and you see it's a very clear downtrend. You're looking to short, right, to sell here. Because you're anticipating it's going to hit the 50 moving average and come down, and you're going to make your profits as it comes down, okay? So based on the 50-minute candles, this would be a good entry to sell, right? Because it's hitting the 50 moving average resistance and it's on a downtrend. But what do you need to do? You always need to check the hourly candles to ensure that it is aligned. So how do I do that? So let me go to the exact point over here. Okay. So let's imagine you want to do a short here. You want to sell short over here at 9768, right? So what I do is I will click on this vertical line. See this vertical line? And I'll move the vertical line to wherever I intend to enter the market. Okay? And say I intend to enter right there. I want to enter the market at 9767. I want to do a sell, okay? Because it's on a downtrend. So what do? I will then click on my hourly candle and ensure that on the hourly candles, it is also on a downtrend. All right? So you can see that over here, where I intend to sell at this point in time, on the hourly time frame, it is also on a downtrend. Okay, because the 18 is below the 50, is below the 200. So the H1 hourly is aligned to the 50-minute candles. And this is what gives you the highest probability of success. If the hourly candles are not in line with the 50-minute candles, I never take the trade. So there are times when the 50-minute candles may show a downtrend, but on the hourly candles, it shows an uptrend. So when that happens, you do not take the trade. You understand? Great. And again, I'll talk more about it in the strategy section. So let's take a look at an uptrend example. Let's go back to Euro USD. Okay. So right now, you can see, for example, the price is coming down and it's finding support at the 50 moving average. So I'm looking to buy here because the overall trend is going up. I'm confident it will go higher and it's going to bounce higher, right? On the 50-minute candles, it's on an uptrend. So what do I need to do? I need to check the hourly candles, the higher time frame. So again, I click on this vertical line. I place it right at my intended entry point. I can draw another black line here and say, okay, I intend to buy at 1995, okay? So I then go to my hourly time frame and I check. On the hourly time frame, is it also on a clear uptrend? Yes. Why? Because you can see the 18 is above the 50 and the 50 is above the 200. So once again, the hourly candles are aligned to the 50-minute candles. And that gives you the best probability of success in following the trend. So let me now show you an example when the 50-minute candles are not aligned to the hourly candles and when it becomes more of a risky trade and a lower probability. So you can see over here that you may identify this as an uptrend, right? Because on the 15-minute candles, right, you can see the moving averages are sloping up. You can see the 18 is above the 50 above 200. And let's imagine that you want to initiate a buy. And you say, okay, I see that, oops, hold on a second here. Okay, you say, okay, I see that the price is kind of like on an uptrend over here, right? And it's bouncing off the moving average, dong, dong, right? So you say, hey, I'd like to buy over here. I like to put a buy over here. So would you put a buy over here? Let's double check. So again, let's take our vertical line, clicking on this. Let's move that vertical line right there to tell us that it's that point in time. We then click on the horizontal line and place it there. And we are saying, okay, we want to be a buyer there. We want to buy over there. Because on the 15-minute candles, it looks like it's going up on an uptrend. Okay, so what I do is I then switch again to the hourly candles, H1. Okay, and I scroll to where my red line is. So again, the red line helps me to see what point of time it was, right? So this is the buy. Okay, so you can see that on the hourly candles, it's a very dangerous time to buy. Why is it dangerous? Because on the hourly candles, it is not an uptrend, it's a downtrend. Can you see that the 200 is above the 50? right? So although the 18, this blue line, this 18 is above the 50, but the 200 is above both lines. So that tells you that on the hourly candles, it's on a downtrend. And sure enough, if you had bought here, it may have gone up slightly and it hit the 200, which is a strong resistance. Boom, it came all the way down and it became a losing trade. So again, whenever you enter and you've got a losing trade, you may say, the market's against me, I've got bad luck. No, it's not because of that. It's because oftentimes you're only looking at it from one time frame. You have to always look at a higher time frame to confirm it is indeed on an uptrend on multiple time frame levels. Alright, so next I'd like to remind you about the importance of always checking the upcoming news on the news calendar at Forex Factory. So every day before I begin my trading for the currency markets, I will log on to forexfactory.com. That's the first thing I do every morning. And I would adjust the clock to my local time. So you have to click on this time and synchronize it to your local time. Save the settings and click on calendar. So you could look at the calendar for today as well as the coming week. So currently I'm doing this video when it's actually New Year's Eve, so markets are closed, there's nothing to look at. So this is the coming week. You can see this is the coming week. So for example, on Tuesday, you can see that these are the different news events, and it'll tell you which currency it will tend to affect. So for example, at 5:30 p.m. local time, there'll be manufacturing PMI from Germany, and from the UK, and this would likely affect the British pound. So there's a red over there. So there's what we call yellow news, there's orange news, and there's red news. So we are only concerned with the red news. Red news means that this news has the potential to drastically change the price of the currency. So for example, the currency could be going up, and when the news is released, it could suddenly crash. Or it could be going up, and when the news is released, it could suddenly spike up. So red news means there's a high probability that the news would create a rapid change in price. So one of the rules that I've taught you in the first course, and we'll carry this forward to the second course, is in most of the strategies, when we enter based on technical analysis, based on certain chart patterns, we never enter just before the news is released. Okay, the reason is because if we enter, for example, on a very nice uptrend and we buy on the uptrend, if the news is released, it could suddenly drop violently and cause us to have a stop loss or to have a losing trade. Similarly, the price could be going down on a downtrend and we are doing a short sell, but the news comes out and the price spikes up, and then we end up with a stop loss as well. So the point is that the moment news comes out, right, it doesn't matter if the price was on an uptrend, on a downtrend, on a consolidation, everything changes when new news is released. So we always avoid entering before news is released. And if we are already in the trade and we have not exited the trade, then we want to definitely exit the trade before the news is released. So if our trade has not hit our target price or the stop loss price, we manually exit the trade just before the news is released. That is a safe thing to do. However, there is one strategy that you will learn in this course called trading the news or scalping the news, where we will specifically buy just 3 minutes before the news is released. And we're going to anticipate that if the price has a rapid increase or rapid decrease, we're going to capture that price movement in either direction. And that is scalping the news. All right, so always go to Forex Factory at the beginning of every trading day. Take a look at the day. What are the red news that's going to emerge, and take note of those red news, put it into your phone, have an alert and alarm. Half an hour before the news is released, your phone will alert you to say, hey, if you're in a trade, get out of the trade. If it's a valid trade that we can do a new scalp, we'll do a new scalp on that news event. Right, so with that, let me move on to the last part of this lesson, which is on Fibonacci ratios and retracements.